You know, those master blueprints that usually live exclusively in these, like, super secretive Wall Street
Oh,
boardrooms.
yeah. The ones that are, projected onto massive screens for people in very expensive suits.
Right, exactly. The documents that are just heavily guarded and hidden behind,
Mm.
like, thick layers of corporate jargon.
Yeah, the ones that show the actual machinery, right? Like how a massive business operates completely behind the scenes. Because they don't just show you what a company is doing. They show you literally the exact levers they are pulling to do it.
Exactly. And, well, because today is Monday, May 18th, 2026, we thought it was just the perfect time to slide one of those heavily guarded blueprints right across the table to you.
Hmm.
Because for this deep dive, we got our hands on SoFi's Q1 2026 Investor Presentation. And I have to tell you, going through our sources, this is not just some, boring spreadsheet.
Not at all.
It is a strategic master document. It
Yeah.
shows exactly how a company transforms from a niche student loan lender into this absolute powerhouse of a financial everything app.
It really is a masterclass, honestly. Like when you look past the standard corporate formatting, which, can be a lot, this presentation is a structural breakdown.
Yeah.
It shows how a company uses vertical integration and brand trust to build this seemingly impenetrable moat in the financial sector.
Right. And for you listening, whether you are trying to catch up on fintech trends or maybe prepping for a meeting, or you're just insanely curious about how modern digital banking is evolving right under our noses, we are going to extract the aha moments from this document.
Absolutely.
Okay, let's unpack this, because before we can even begin to dissect like how they pulled off this massive transformation, we really need to understand the sheer scale of the operation. So, where exactly is SoFi standing in the first quarter of 2026?
Well, they are standing on a mountain of capital,
A
basically.
mountain.
Yeah, if we look at the raw numbers from the presentation, the sheer accumulation is just staggering. I mean, their total deposits just surged past the $40 billion mark
40 billion. That's with a B, right?
with a B.
Yeah.
Yeah. And they added 2.7 billion of that in just one single 3-month window.
Oh, wow.
It's literally a tidal wave of consumer cash moving into their ecosystem. And, that deposit growth is translating directly into top-line revenue.
Right.
Their adjusted net revenue hit $1.1 billion for the quarter, which, by the way, is a 41% year-over-year surge.
Wow. Okay, I want to put this timeline into perspective, because going through the background notes, it's wild. So, CEO Anthony Notos joined back in 2018,
Hmm.
and by 2020, they had 1 million members. Fast forward to today, in 2026, and they are projecting 14.7 million members.
Yeah, it's huge.
It is. But, revenue and member growth are one thing. Anybody can grow if they set enough money on fire with marketing, right?
Very true.
So the question is, are they actually keeping any of that money?
And that is the million-dollar question. Or, in this case, the $167 million question.
Right.
Because they actually posted $167 million in GAAP net income, and this marks their 10th consecutive quarter of profitability.
10 quarters. So that's 2.5 years of just consistent, undeniable profit.
Exactly. And what's fascinating here is why these specific metrics matter so much to the institutional investors reading this presentation.
Wait, break that down for us.
So the distinction between GAAP net income and adjusted EBITDA tells like two vital halves of the same success story. GAAP net income is the official profit, measured by standard, highly rigorous accounting rules.
Strict scuff.
Exactly. It includes all the painful deductions, depreciation, amortization, taxes, all of it. So hitting GAAP profitability for 10 consecutive quarters signals to the market that SoFi has firmly exited that, flashy cash-braining startup phase.
Right. They aren't just burning venture capital anymore.
Exactly. They have matured into a stable, highly reliable, profit-making institution.
It's the grown-up metric, basically.
Yeah.
It proves the business model actually works when all the official rules are applied and you can't just hide behind clever accounting.
Precisely. But then you have the other half, which is adjusted EBITDA, and that stood at $340 million with a massive 31% margin. Wow.
Yeah. EBITDA strips away those taxes and non-operating costs to show you the ultimate metric for a company's pure cash-generating power.
So it's like the raw engine output.
Exactly. It shows how efficiently the core engine is running. And, the fuel for that engine, that $40 billion in deposits.
Right. And this is what I was wondering. How did they suddenly get so much fuel? Let's talk about the mechanism behind this, because They weren't always able to just hold on to $40 billion of consumer cash, right?
No, they definitely weren't. And this connects back to a crucial historical turning point for them, which was acquiring a national bank charter.
Okay, stop right there. Explain this to me like I'm completely new to the banking world. Why is a bank charter such a massive deal? Weren't they, like, already acting like a bank?
Only on the surface, really. Before they had that official federally recognized license, SoFi, like almost all early-stage fintech companies, honestly had to act as a digital middleman.
Okay.
They had to rely on third-party legacy partner banks to actually hold the deposits and facilitate the loans on the back end. So they were basically renting out the actual banking part of their business.
Yes.
It's almost like a really popular restaurant concept, but they don't own a kitchen. They have to rent a commercial food truck down the street to actually cook the meals. And that food truck is taking a massive cut of every single order.
That is a perfect analogy. The partner banks took a massive cut. But obtaining the bank charter was like, finally buying their own state-of-the-art kitchen.
Right.
Suddenly, they eliminated those third-party fees entirely. They can hold your deposits themselves, and more importantly, they can use that $40 billion in capital to fund their own loans.
Oh, wow.
Yeah, so their overhead dropped dramatically and their margins just exploded overnight. It fundamentally changed their profit structure.
That makes so much sense. So the bank charter is the bedrock. It gives them the foundation to hold the money and lend the money without paying a toll to some middleman. But, that naturally leads us to a much bigger question. Having the kitchen is great, but you still need people to walk through the door and actually give you their money.
Right.
How do they capture and keep all those billions in deposits? And the answer, looking at the presentation, is their everything app strategy.
Yes, they are taking an incredibly aggressive approach to consumer finance. They don't just want to be where you get a personal loan. I mean, they want to be the single destination for your entire financial life.
And I get the appeal, honestly.
Yeah.
Because if you think about the average person's digital life right now, it is exhausting.
Oh,
You
absolutely.
have one app for your checking account, a totally different app with a different password for your student loans, another one for your crypto investments, and then maybe a separate brokerage app for stock. I mean, it's a mess.
It's highly fragmented, and fragmentation causes friction for the consumer.
Exactly. So SoFi comes in and says, well, what if it's all just one login? And they're building some serious magnets to lock people into this single ecosystem.
They really are.
Like, I'm looking at the perks they've built, and they are incredibly aggressive. They're offering a 4.60% annual percentage yield, or APY, on banking. Plus, they offer $2 million in FDIC insurance, which is huge for giving people peace of mind. And right alongside that checking account, under the exact same roof, you have crypto trading for dozens of tokens like Bitcoin and Ethereum.
Right.
You have tailored investing, and you have their legacy student and personal loan refinancing.
It is a totally seamless integration. But you touched on something crucial there, which is the 4.60% APY.
Yeah, and this is where I really have to push back a bit. Look, traditional legacy banks pay practically nothing on checking or savings accounts.
True.
We are talking pennies, like 0.01%. So paying out 4.6% to millions of users sounds unbelievably expensive.
It does.
If I'm an investor looking at this presentation, I'm terrified. How does an everything app offering these sky-high yields not just go completely bankrupt trying to buy customer loyalty?
And that is the exact skepticism institutional investors bring to the table.
Right. And SoFi's answer to that, the actual mechanism that prevents them from bleeding cash, is the secret weapon outlined in the presentation.
Okay.
It's called the Financial Services Productivity Loop, or the FSPO.
The productivity loop. Walk us through how that actually works in practice.
So the productivity loop is a virtuous cycle. It's where the profits generated from one product actively lower the operational costs of the other products.
Interesting.
Yeah. Let's trace a user journey to see how it works. Say a customer comes in purely for student loan refinancing because SoFi is offering a great rate.
Okay, so SoFi had to spend money to get that customer, right? Like marketing, ads, processing fees.
Exactly. That is the customer acquisition cost. But once that customer is inside the app to manage their loan, they see an ad for that 4.6% APY on savings. It's just right there on their dashboard.
Oh, I see.
So with 2 clicks, they open a checking account. Then, maybe a week later, they notice the investing tab and decide to buy a little bit of Ethereum. Wait, so suddenly, SoFi has sold 3 entirely different financial products to this person, but they only ever paid that initial marketing cost once.
You nailed it. And the standout metric in this presentation proving that this loop actually works is their cross-buy or ex-buy rate, which currently sits at 43%.
So nearly half of their entire user base is using multiple services.
Yes. And when a customer uses multiple products, the unit economics, meaning the profitability of that single individual, completely skyrockets.
Because the marketing cost is essentially zero for those extra products.
Exactly. Because the customer acquisition cost drops to zero for the second and third products, the customer's lifetime value, or LTV, dramatically increases.
Right.
The high margins on the personal loan subsidize the expensive 4.6% APY on the checking account, and then the checking account keeps the user logging in daily, which subsidizes the marketing for the crypto platform. It's a self-feeding engine.
Okay, the light bulb just went on for me. They aren't going bankrupt paying out high yields because the app itself is a giant, highly calibrated cross-selling machine. They use the high APY as the hook, but they make the real money on the back end when you inevitably use their other services. But here is the catch. That productivity loop relies entirely on getting customers to trust them with multiple, very sensitive facets of their financial lives.
Right.
Which brings us to how they actually prove to the market that their engine is efficient and not just some, temporary growth hack.
Right. And to prove that efficiency, the presentation highlights a concept called the Rule of 40.
I saw that chart. Break down the Rule of 40 for us, because it seems like a massive point of pride for them.
It is. So the Rule of 40 is actually a premier benchmark that originated in the software as a service, or SaaS, industry.
Okay.
Historically, software companies and fintechs faced a dilemma. You can either grow your revenue extremely fast by burning through cash, or you can be highly profitable but grow very slowly.
Right. The classic startup problem.
Exactly. The market decided that a truly elite company should be able to balance both. So the rule essentially dictates that if you add a company's revenue growth rate percentage to its profit margin percentage, the total combined number should be over 40.
Okay.
If it's over 40, you are considered a top-tier elite operation.
Here's where it gets really interesting. It's like proving a sports car can do 0 to 60 in 3 seconds, but also gets 40 miles to the gallon.
That's a great way to put it.
It's supposed to be a paradox. You are proving to the market that you are both lightning fast and highly fuel efficient. And looking at the data, SoFi isn't just hitting 40. They're averaging 59% over a 4.5-year period.
Yeah, they are completely crushing the benchmark. But if we dig deeper into the shifting dynamics of how they actually achieve that 59%, you see a really compelling strategic evolution.
What do you mean, how did it shift?
Well, let's look back to the fourth quarter of 2021. Back then, their Rule of 40 score was driven almost entirely by a 54% pure revenue growth rate with very little profit margin. They were in high-speed, aggressive acquisition mode, just grabbing as much market share as possible.
Burning gas to win the race.
Exactly. But fast forward to this presentation in Q1 2026, and the composition of that score has completely flipped. Their score is now being driven heavily by a highly profitable 31% EBITDA margin.
So they went from just growing fast at any cost to growing profitably. The engine got more efficient as it scaled.
It did. And that immense financial health allows them to invest heavily in the one thing that makes the productivity loop function, which is brand trust.
Right.
In the presentation, they track a metric called unaided brand awareness.
I saw that. What exactly is unaided awareness, though?
So it's the percentage of consumers who can name a brand off the top of their head without being given a list of options. Like, if I ask you to name a fast food burger joint, you instantly think of McDonald's.
Right.
That's unaided awareness. For SoFi, that number jumped 2.2 times, going from just 4.5% in 2022 to a solid 10.0% in 2026.
10% of the general public just organically thinking of SoFi when they think of banking or loans.
Yeah.
I mean, that is a massive mental real estate grab.
Yeah.
And they're backing up that awareness with serious industry validation. The sources highlight recent awards, like Forbes ranking them the #1 U.S. bank and J.D. Power naming them the top choice for DIY investing. It proves that their two core pillars, which are brand building and continuous innovation, are actually resonating with real people. I mean, it's driving a 38% compound annual growth rate, or CAGR, in their total membership.
And we should clarify what that 38% CAGR actually implies for anyone who isn't staring at spreadsheets all day.
Yeah, please do.
It doesn't mean they are just adding a flat, static number of users every year. Compounding means that growth is snowballing on top of itself. The 38% growth this year is calculated on a much larger base than the 38% growth last year.
It's exponential.
Exactly. When you have high unaided awareness, prestigious third-party awards, and a product ecosystem that genuinely rewards users for consolidating their finances well, that snowballing growth rate becomes highly sustainable.
So we have this elite status established. They've built the ultimate kitchen. They have the menu everyone wants, and they have a massive 14.7 million member base in 2026 that's snowballing larger every day.
Yeah.
The question now becomes, where are they driving this incredibly efficient sports car next? How do they keep this momentum going? Let's look at their roadmap to the 2028 horizon.
This is a critical pivot in the presentation, actually. It shifts from validating their current model to projecting their future dominance over the next 2 years.
And the projections are staggering. I mean, they are laying out a goal to jump from $1.5 billion in revenue back in 2022 to a projected $7.9 billion by 2028.
It's massive.
That is maintaining a 30% compounded growth rate over 6 years. And they expect their adjusted earnings per share, or EPS, to climb to $1.12.
Which is a remarkable turnaround. For context, they were operating at a significant loss per share just a few years prior in 2022.
Right.
Hitting $1.12 in EPS shows profound operating leverage, meaning that as their revenue goes up, their costs are staying relatively flat. So a massive portion of every new dollar drops straight to the bottom line.
Right. Now, to get to that $7.9 billion finish line, the presentation outlines some really wild new tech rollouts. We are talking about modernizing the toolkit entirely.
Yeah.
They're launching SoFi Crypto, trading directly from FDIC-insured accounts to maximize security. They have an AI-powered SoFi Coach to give personalized financial advice. They even have SoFi USD, which is a proprietary stablecoin pegged to the dollar.
And, the mechanism behind that stablecoin is vital to understand. SoFi USD is backed one-to-one by actual cash sitting directly at the Federal Reserve.
Why does that matter so much?
Because if you look at the history of crypto, other high-profile stablecoins have crashed entirely because they were backed by risky commercial paper or volatile algorithms.
Right.
By backing their coin with hard cash at the U.S. Central Bank, SoFi eliminates the liquidity risks that terrify institutional investors. It's a massive confidence play. It basically tells the market, we do crypto, but we do it with the safety of a heavily regulated bank.
It's the grown-up version of crypto. I love that.
Yeah.
But amidst all these flashy consumer-facing features, the AI, the crypto, I zeroed in on something on the B2B side, the business-to-business side. That really left me scratching my head.
Oh, yeah?
The presentation says they're actively offering their core ledger as a service to other external businesses.
They are.
Now, wait a minute. A core ledger is the central technological nervous system of a bank. It is the absolute heart of the operation that tracks every single transaction, every fraction of a cent, and every balance in real time.
It is.
Why on earth would you take your most critical, proprietary technology and rent it out to your potential competitors? Aren't they just arming the enemy?
If we connect this to the bigger picture, it is actually a brilliant display of how vertical integration completely changes a company's business model.
Okay, how so?
To understand this, we have to look back at two massive acquisitions SoFi made a few years ago, buying technology platforms called Galileo and Technisys.
Right, they spent billions acquiring those tech companies.
They did, because by buying those companies, SoFi didn't just improve their own consumer app. They literally bought the underlying infrastructure that powers a massive chunk of the global fintech industry.
Okay, so they own the actual pipes of the financial system.
They own the pipes, the processing power, and the ledger itself. By renting out the core ledger, SoFi transforms from being just a consumer bank fighting for retail deposits into a dominant B2B tech platform. Think of it like Amazon. Amazon started by selling books to consumers, but their real power was building Amazon Web Services AWS and renting out their cloud servers to other companies.
Oh, wow.
SoFi is doing the exact same thing with banking infrastructure. Every time another fintech company uses that infrastructure to process a transaction, SoFi gets paid a fee.
Yeah.
It diversifies their revenue away from just consumer lending and literally turns their competitors' growth into their own profit.
Oh, wow. So they are essentially saying, sure, try to launch an app to compete with our consumer business, but to do it, you have to pay us to use our technology.
Exactly.
That is a completely different level of playing the game.
It is. And we really have to consider the sheer scale of the opportunity here. The presentation emphasizes the massive white space, basically the untapped market that is still available to them.
Right.
Because despite all this incredible growth, despite $40 billion in deposits, SoFi currently holds less than 1% of the total U.S. deposit and investing market.
Less than 1%.
Yeah.
That is almost hard to believe, but it just shows how astronomically huge the legacy banking sector really is. There is so much pie left to eat.
Precisely. And they are aggressively targeting specific slices of that pie, particularly the $1 trillion U.S. credit card debt market, using their personal loan refinancing products.
Wow.
When you have an ocean of market share left to capture and you have a productivity loop that drastically lowers your cost to acquire those new customers, the path to $7.9 billion in revenue by 2028 suddenly looks very, very achievable.
So to pull this all together for you listening,
Mm-hmm.
we started by looking at a blueprint of a company that took an incredibly aggressive timeline.
Mm-hmm.
They secured a bank charter. They bought their own kitchen so they could control their own destiny and hold their own deposits. They built this incredibly efficient cross-selling productivity loop to make sure they weren't bleeding cash while offering top-tier perks.
Right.
And then they combined that healthy engine with bleeding-edge technology like AI coaches and Federal Reserve-backed stablecoins to turn a simple student loan app into a $40 billion deposit juggernaut.
Yeah.
This entire Q1 2026 presentation really is a masterclass in durable growth and operating leverage. They aren't just participating in the financial sector anymore. They are actively rewiring how it works.
They are. And as we wrap up this deep dive, this raises an important question, something really worth pondering based on that B2B strategy we just discussed.
Yeah.
If SoFi successfully achieves its 2028 goal of becoming the core ledger technology, the actual plumbing that other fintech companies run on, while simultaneously dominating the consumer market with its own everything app, they are effectively playing both sides of the chessboard.
Wow.
What happens to the traditional banking landscape when the financial institution you bank with is also the invisible technological engine powering all of its own competitors?
That is a wild thought to leave on. It is like discovering the referee and the star player are the exact same person. It completely changes how you look at the game. Well, thank you so much for joining us on this deep dive today. We hope you walk away with a fresh perspective, and we encourage you to keep questioning the hidden architecture and the corporate blueprints of the financial infrastructure all around you. Until next time.